Corporate finance practice problem using Onenote. Convertible bond sale, gain, and rate of return calculations. Get ready, it's time to take our chance with corporate finance. Here we are in Onenote. If you have access to Onenote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, down in the 1925 Convertible Bond Sale, Gain, and Rate of Return tab. Also note, when using Onenote, look at the Immersive Reader tool. Our presentations will also be in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculation on the side, and on down below. We're looking at those convertible bonds once again, which give you the option but not the obligation to convert them into some portion of common stock. We're going to consider the sale of them and the gain that would result on the sale, as well as the rate of return calculation. So we've got the convertible bond outstanding. The rate is 10%. The conversion ratio, meaning the number of shares we can convert them into if we chose to, being 55 shares. The common stock price, meaning the stock price of the shares we can convert them into if we so choose, is 20. They mature in 14 years. The conversion premium, which by definition is the amount over and above the conversion value, meaning the value of the stocks. If we were to convert the bonds and consider the market value, the conversion premium is the amount over and above to the bond price. We'll calculate, or that will help us to figure the bond price. Assume we buy one bond and sell it in 1 year, and the par value is $1,000 for the bond. The common stock price, this is 1 year later, is going to be $27 after a year, whereas before it was at $20. And the conversion premium at that point in time is going to be 16 as opposed to the 71 a year later. Okay, let's start off with the conversion value at the purchase date. So the conversion value is that 55 shares. So we're going to imagine we got the bonds, we're going to convert them, or think about if we were to convert them, what would be the value of the common stocks at that point, which we know because we know the stocks are trading on the market. So we got the 55 shares we can convert them into times the 20 stock price. 55 times the 20 would give us a conversion value of the 1,100. They told us the conversion premium is 71. Now the conversion premium is by definition the amount over and above the conversion value that gets to the bond market price. So sometimes we might think of that the other way around, meaning we might have the bond market price and then figure out the conversion premium. But if we're given the conversion premium, and we can back into the bond price. So you might, if you're thinking about book problems and whatnot, just think about the formula in your mind for the conversion premium and then back into the unknown, which in this case is the bond price. And so we're going to then say that we have the conversion value is going to be the 1,100. Conversion premium is 71. Adding those together, that means that the bond price is at the 1,171. Then we're going to consider the conversion premium at the point of sale. So we're going to think about this a year later. We have the information down below, the common stock price at 27, the conversion premium now at 16. So given those numbers, we're going to say, well, we still can convert these into 55 shares. And now the market price at that time is 27. So 55 times 27 gives us a conversion value of 1,485. Then they give us the conversion premium, which once again is the amount over and above the conversion value to get to the bond market price. So then we would say, okay, that means that the 1,485 plus the conversion premium of 16 bond price then at that point is 1,501. Now, we also want to consider the interest that we earned on the bond for this 1 year period that we had here before we're thinking about the selling of the bond. So the interest earned calculation would be that $1,000. We said the rate was the 10%. So there would have been 1,000 times 10% or earned interest of the $100. So if we were to sell the bond, note we're not talking about converting the bond. We're saying we have that conversion option but didn't exercise it. We would then say, okay, rate of return calculation, we've got the sale of the bond. We said the bond price at the sale point was 1,501 versus the cost, plus let's add in the interest. So we got the return plus the interest. Note, this would be different, of course, like for taxes, because you might have different tax rates or tax implications on capital gains versus interest and whatnot. But we're talking basically total return here. That would mean that we got an inflow from the sale and the interest of the $1,601. The purchase price we calculated up top, you will recall, or I'll help us recall here, the $1,171. So that would mean that you got the 1,601 minus the 1,171 gives us a gain of the 430. That's the dollar kind of gain that we would have. If we compare that then to how much we paid, we can then get our return, and that would be then equal to the 430 divided by the 1171. That would give us our 0.36, or if we move the decimal place 2 points over or multiply times 100 times 100. Hold on a sec. Let's do that again. We got the 430 divided by the 1171, and then times 100 would give us the 36.72%.